good day. Chris Weston here, Head of Research at Pepperstone. And I want to take a step back because last week we talked about the US bond market being very much the centre of attention. I put out a few charts which really caught my eye and actually, to be fair, have come fairly much to fruition. The idea that we're going to see flatter curves. We've seen inversion now between 3-month, 10-year US Treasury yields. What's the message that we've been seeing there? We talked about what's happening in copper prices. Copper now down 12 days in a row. There's a demand cycle that's obviously being in play. Obviously, the perception that Chinese Q1 GDP numbers are going to be dramatically lower. You know, the estimates at the moment are somewhere from the current clip of about 6%. Perhaps even falling down to about 4.8%, perhaps even lower than that, depending on the economist you're looking at. But there's no doubt that the copper price has been falling. We've been seeing real yields. If you look at inflation-adjusted Treasury yields on 5s going down to negative 20 basis points, you've seen 10s going down to negative 5 basis points. Of course, that real yields boosted the gold price. And if you have a look at the daily chart, for example, of gold priced in US dollars, you've seen it trading up to the top end of that range at 15.90. If we do see those yields go deeper, that pool of negative yielding debt globally, if we take that more broadly into European debt and other bond markets as well, which currently sits around $13 trillion worth of negative yielding debt. That's pushed up materially from around 10 trillion a couple of weeks ago. Now, if that continues pushing higher, that's something we'll be looking at as well. So as we go into the beginning of the week, of course, we've got our eyes firmly on what's happening in China. Now, if you listen to some of the guys on the ground, some of the experts, the respiratory experts, some of the virologists out there in China, they have been saying that we should get some stronger clarity around the actions, the strong actions that the Chinese have had to take, and how this will ultimately manifest in how they see this playing out. We should get that colour between the window the 3rd of February through to the 8th of February. Of course, Chinese equity markets coming back online, and we'll keep a firm eye on there, as we will do in terms of the money markets as well. So we're looking at things like Shibor and the idea that the PBOC are probably going to have to come in and flood liquidity there as those businesses want to get working capital and that cash to fund their business in the short term. So certainly something we are watching there very closely, and how that impacts things like real yields, and that could have an impact on things like dollar yen going forward. The other one, of course, is we have heard from the Bank of England. They've done this dovish hold as we expected to happen. The market was probably positioned for that. We have seen sterling performing quite well. And if you have a look at the chart and the oversight of the markets throughout this week, you know, that pickup in implied vol has resonated in yen buyers. The Swiss franc's done quite well. You know, we've been looking very closely in our daily research in the mornings. We look very much at what's been happening in the Chinese yuan, the offshore Chinese yuan, the CNH, relative to the Japanese yen. And I think we've been seeing that as a reasonable barometer of risk appetite. But it's been yen buyers. You know, our flow has been very much on the Swissy, but in the more sort of broader market, it's been the yen. The yen's been the best performer, and certainly against some of the sort of high beta currencies. So certainly SAFA against the yen's been the best performer. If you've been short, you've probably picked up over the last 5 days 2.9%. Kiwi and Aussie, the antipodeans, obviously being heavily offered relative to what's been happening in the yen. Whether that continues throughout this week is obviously yet to be seen. If we get some clarity around what's happening and an assurance around what's happening in the coronavirus, you know, and the idea that I think the concern obviously now from the WHO is not so much around what's happening in China, but it's the spread into some of the other countries with very high populace, you know, countries like India, Indonesia, those kind of countries with perhaps not as good health services as what we're seeing in China as well. That's where the WHO are showing greater concern. I think that's where the market's going to be looking at going forward. But if you have a look at the chart of Aussie yen 1 week implied volatility, I'll talk about implied vols in a second, but for me this is a really key chart in terms of how the market's perception of risk is going. You can see that sort of 10% level is a clear line in the sand, and that's something that we're looking at very closely as well. If we get a material break of that level, I think that's going to be a sign that, you know, risk appetite more broadly is coming under pressure. A lot of people look at dollar Korean won, or dollar in this situation Thai baht, or the Taiwanese currency there, because, you know, they've been fairly closely linked to this situation as well. But for me, I keep it sort of developed market, and Aussie yen seems to be the trade. But we have seen that sort of risk off vibe playing through. But, you know, it's a new week, and if we get some new colour around that, it's something we're watching. So we watch in terms of those week. Let's go straight to the economic data. Obviously, we talk about what's happening in the US. The ISM manufacturing numbers beginning of the week, I think, are going to be absolutely key. The market's shown a great propensity to be leveraged to that. They see this as a forward-looking cyclical number, and the market is looking for that to deteriorate at a slightly slower pace. So the index there expected to tick up to 48.4. Of course, if that comes out below 48, the concern will be, given that the regional numbers like Richmond have been so strong, the market's going to be quite confused as to why we haven't seen a snapback in the ISM manufacturing number as well. And you're going to see those deeper negative yields. You're going to see that flatter curve with the long end outperforming as people pile into duration, even though that's kind of massively overbought at the moment. And you're going to see gold prices probably trading to $1,600. You're going to see dollar yen lower. Of course, if it comes out higher, that could be good for risk appetite. It could be bad for gold. It could be good for dollar crosses more broadly. And you could see a slight lowering of inflation of implied vol. Going to the back end of the week in the US, you've got the services ISM number. Of course, that's for me really important because the US is a service-driven economy. But the market, whether you're looking at equities, whether you're looking at credit, FX markets, current commodities, they haven't been overly sensitive to that. But we are expecting that to snap back and grow at a slightly faster clip. That to me is important, but the market is not so sensitive. The traders will be very keenly watching the non-farm payrolls number on Friday in the US. The market's looking for 158,000. You know, the 12-month average is just over 200,000, so you'd probably be looking for a reasonably good number to come out there. What's probably somewhat more important is the unemployment rate, expected to be at 3.5%, but also what's happening in inflation. The average hourly wages last month were 2.9%, first time we dipped under 3 handle since 2018. Now the market's expecting that to come back again above 3%. So that would be something that I think inflation expectations will be looking at very closely, and the Fed will be looking at reasonably closely as well. So that's what we're looking at this week. Of course, if some of those data points do come out on the downside, it could really add weight to this bid in duration we've been seeing and keep implied volatility fairly high. Going to the Australian market, you know, have a look at the daily setup of the Aussie dollar against the US dollar. I talked about what was happening in Aussie yen, and that looks pretty weak at the moment, and we're keeping an eye on implied vol there. But, you know, the setup in Aussie dollar is quite interesting. You've got this really strong level of support coming down to 67 cents. I think if you're a mean reverted trader, you know, that's the level you're going to be looking to accumulate into. Of course, it's pretty easy to understand where you're going to have your stops in that environment. And again, I'll come to the implied vol chart in a minute. But that 67 cent level, I think, is absolutely key. If we're going to see people looking to buy into that, you know, I think that could be quite an interesting one as well. And I think, you know, you go into Canada. Sorry, I mean, we talk about the RBA meeting as a driver there. We're not expecting rates to be cut, but, you know, given everything that's been going on with bushfires, what's been going on in coronavirus and other things that have been playing through the fairly low growth environment we've been seeing here, it goes without saying that they're not going to be overly hawkish in that situation. But in my opinion, they're not going to cut rates. The question is, will they open the door for rate cuts, which of course is what the market's expecting longer term. We've got Mr. Lowe speaking later on the week in his semi-annual testimony as well. So there's a bit of event risk to play through in Australia, not just what's been going on the coronavirus. Have a look at the charts in dollar CAD as well. This is getting a bit of interest from clients. Up into 133, it's kind of the role reverse of what you're seeing in Aussie dollar. You know, up into 133, you're seeing some good resistance there, good supply coming into the market. That's been the case for a while. Again, are we going to see a bit of a weakening in the CAD? Well, we've got employment data towards the back end of the week. Again, you know, if you see a weak number there, and it's going to take a few days to get there, of course, you know, into 133, is that a level that we're going to be looking to fade? We're staying on the employment theme. You know, in New Zealand, we get employment data coming through there as well. The Kiwi, along with the Aussie, has been quite weak, specifically against the low-yielding sort of defensive currencies. And again, that's something we're going to be watching very, very closely in that regard as well. Now, we'll have a look at the charts that we've got of the US political situation, because I think this is absolutely key. You know, the market has been looking at the fact that Bernie Sanders is now clear favourite, not just to win Iowa, and they will see the Iowa caucus coming through on Monday on the 3rd of February. Over the weekend, though, do keep an eye out. I'm saying this before we do get some of the polls, the Des Moines CNN poll that people will be looking at as a good precursor for Iowa. It does seem that Bernie Sanders is clear favourite. He did pretty well in 2016. He narrowly missed out to Hillary Clinton there, but so he's a kind of well-known entity, and Iowa seemed quite recipient to him. It's ultimately how he's seen. How does he poll? We'll extrapolate that into New Hampshire, where he's expected to do quite well. But the market's not ready for Bernie Sanders. Now, that's not a political view in my capacity, but they're not. You know, if you have a look at the idea he's going to take on big tech, he's going to take on Wall Street with transactional taxes and other factors, the market will obviously have to pay a higher risk premium for the closer he gets, not just to a nominee position for the Democrat position, but ultimately for to go toe-to-toe with Donald Trump on the 3rd of November as well, and ultimately the presidency. But if you have a look at this chart here from Bloomberg, you can see the predicted chance here of who's going to become the actual nominee for the Democrat Party. And you can see here the green line is Bernie Sanders now. He's got a 40% chance according to Predict It, one of the Kiwi betting sites. But certainly that's been growing, and you can see Joe Biden, the white line, has been pulling back a little bit. So there's everything to play for, but it looks on the betting sites at the moment, they have been pretty bad, that Bernie Sanders is now the favourite. And of course, as we get closer towards that, if he continues to poll pretty well, you are going to see people looking to be in the yen, looking to be in things like gold as a kind of natural hedge against what happens with Bernie Sanders as well. So what does this all mean? We are looking at what's happening in the volatility structures for the week. As I talked about Aussie yen, you can see that 10%, that's the 53rd percentile. That gives us an expected move up or down in the week of 86 points, 86 pips. That gives it a range 74.06, 72.34. So if I'm looking to trade Aussie yen positions, given that I like to use 4-hour or daily charts, I'm going to be looking to try and leave my stop loss somewhere about 86 points ahead. That's going to give me a definition in terms of how much risk I'm going to prepare to take on. It gives me a sense of position sizing and how much reward I therefore want to take on as well. We go into Aussie dollar. You can see vols have picked up again. Last week we were talking about most of these currencies being into that 20 percentile. That's now mid-range of the 12-month range, and you can see that's 52nd percentile, with an implied volatility on 1 week at the money of 7.75%. That gives a move in Aussie dollar of 61 points. So despite the fact we've got the RBA meeting where I don't think they'll cut rates, but it's what they say going forward. I think it's more important. And we've got Dr. Lowe speaking later in the week in his semi-annual testimony. The market's saying that, with a near 68% level of confidence that it's going to be contained within a 67.80, 66.58 range. Sterling Aussie, you can see the 211 pip move expected up or down, but when you put it into context, you've got a 20 percentile there as well. Euro dollar, that bastion of all things lifeless, 16 percentile, an implied vol of 3.74%. It's just a non-event. It's very, very difficult to trade euro dollar. We're not seeing huge flows in that as you'd imagine, given that it's just pretty much anchored to that 110 level at the moment. And dollar CAD, you can see those vols have picked up a little bit. We talked about that potentially going into 133, where we're looking to fade that. Have a look at the other markets we can see there. The VIX has pushed up a little bit. This is the implied volatility in the 30-day implied volatility on the S&P. That's picked up to 15.49, 32nd percentile. And incredibly, oil is still very low, even though you've got that price still down into sort of the low 50, 52, 53 levels. And that's something that we're watching very, very closely as well. Have a look at risk reversals, because I think, this looks at effectively the relative skew on 25 delta call options relative to puts, and that vol differential between the two. So you can see here that Aussie dollar sits at 0.655. So effectively people are better buyers and have been better payers of put volatility relative to call volatility. That tells you a little bit about semantics, that people are actually seeing a greater downside move than upside moves, and that's been coming more in favour of put volatility. Makes a lot of sense. We've seen spot prices moving a little bit lower, but the market is positioned in terms of skew quite bearishly at the moment. It's not at extremes by any means. I like to look at these in extremes. I think gold's a really interesting one there as well, because you can see here that that's positive at 1.71. So that tells you that call volatility for 1 week 25 delta options on gold are trading 1.71 vols higher than puts. Again, that's still not a particularly extreme. So even though we've got price at 15.90, people have been better buyers of call vol, but it's not a very much extreme. You can see that mid-range of the 12-month range there as well. So we like to look at vols. We look to look at risk reversals. It looks at the skew of call volatility minus put. If it's negative, then you can see that people have been better buyers of put volatility, which is obviously more bearish than call. So that's something we look at just to get a guide of semantics. And as we go into the new week, let's have a look at how the market's positioned on rates after everything we've been seeing from the Bank of England, everything we've been seeing from the Fed and various factors. You are seeing a dovish shift in rates markets. Have a look at the Bank of Canada. They're going to be very focused on what's happening in employment as we go through the week, but there's a 26% chance there of a rate cut. I think the market hasn't really bought into this slightly dovish shift that the Canadians have gone there, but they have now 37 basis points of cuts being priced through the Canadian swaps curve. So just under 2 rate cuts going there, or just over 1, should we say, 1.5. Bank of England, so obviously they left rates on hold, dovish hold there, but the market's saying on balance in March we've got about 11% chance they cut rates. There's 1 full rate cut being priced throughout the curve. Australia, so we talk about the fact we've got an RBA meeting, the market's pricing a 17% chance they cut. So in theory, when they leave rates on hold, it's really about what they say going forward. There's 37 basis points of cuts being priced in, so 1.5 rate cuts being priced in there. So the market is on balance seeing rate cuts across the curve, but it's only very small being priced in. These upcoming meetings are going to be pretty much non-events in the market's eyes. It's about the outlooks, and if you look at the swaps curve going forward, the market is positioned for slight deterioration. That's probably in line with what we've been seeing in this flattening of curve as well. So good luck to everyone. I think it's going to be a really interesting week. We are watching what's happening in ISM manufacturing, some of this US data. We've got our eye firmly on what's happening in the coronavirus. We'll get a greater update on what's happening and a clearer assumption. And how much of that's already priced in is something there. We're watching the RBA. Will they open the door for a rate cut coming through in April, perhaps May? Something we're watching there as well. So good luck. If you've got any questions, do reach out to the team at Pepperstone here.